Here is a sentence most people will never say out loud, but millions are feeling right now. I have been watching the news, watching the red on my screen, and thinking, should I just pull everything out and wait until this is over? 3 weeks ago, when the headlines hit, I looked at our family's brokerage account the way you check the weather before a road trip. Except the forecast was a hurricane. Oil spiking, defense stocks surging, everything else sinking. My wife asked me at the kitchen table the simplest and most terrifying question a spouse can ask: are we going to be okay? And I realized something. The fear I was feeling was not new. It was the exact same fear felt by a father in 1941 listening to the radio the morning after Pearl Harbor. The same fear felt by a young couple in 1973 watching gas lines stretch around the block during the Yom Kippur War. The same fear felt by every single person who has ever watched the world crack open and wondered what it meant for the quiet little life they were trying to build. So, I did what I always do when emotion tries to drive the car. I went to the data. I pulled up 85 years of stock market history, every major conflict from World War II through today, and what I found was not what I expected. It did not make the fear disappear, but it replaced panic with a framework, and a framework is something you can actually use. That is what this video is. Not a prediction, not a promise, a set of rules pulled directly from what the numbers have shown again and again across wars most of us never lived through, and at least one we are living through right now. Rule number 1 is the flinch is almost always worse than the fall. Here is the data point that changed how I think about every scary headline. Across more than 24 major geopolitical shocks since World War II, the average one-day drop in the S&P 500 was just 1%. Not 10, not 20, 1. The average total drawdown, meaning the full peak to trough slide, was about 4.5%, and the average time to hit bottom was roughly 18 days, with a full recovery to pre-event levels in under 40 days. Think of it like a car hitting a speed bump. The jolt feels violent in the moment, but the car keeps moving. The problem is not the speed bump. The problem is if you yank the steering wheel in a panic and drive off the road. That is what selling into fear does. This week, if you are watching red numbers, write down the date. Set a calendar reminder for 40 days from now. When that reminder goes off, look at the market again. History says you will be surprised. Rule number 2 is distinguish the war from the recession. This is the single most important filter I have ever learned, and most people have never heard it. LPL Financial ran the numbers on decades of crisis events and found something striking. When a geopolitical shock happens during a healthy economy, the S&P 500 averages roughly a 10% gain over the following 12 months. But when that same kind of shock happens near a recession, the average 12-month return is negative 10%. Same type of event, opposite outcomes. The difference is not the war. The difference is the soil the war lands on. Picture 2 identical rainstorms. One hits a field with deep roots and solid drainage. The other hits a hillside that is already eroding. Same rain, very different results. So the question you should be asking right now is not how bad is the war. It is how strong is the economy underneath it. That is where your attention should go. Rule number 3 is never confuse a headline with a folding period. Behavioral economists have a term called loss aversion, and it means the pain of losing a dollar is felt roughly twice as intensely as the pleasure of gaining one. When more headlines flood your phone, that asymmetry goes into overdrive. Your brain starts treating every push notification like a fire alarm. But here is the thing about fire alarms. They do not tell you whether the building is actually on fire or whether someone just burned toast. During World War II, from 1939 to 1945, the Dow Jones gained 50%. During two of the most catastrophic wars in human history, the US stock market was up a combined 115%. If you had sold at the first siren, you would have missed one of the greatest wealth-building periods in modern history. The fix is simple but uncomfortable. Define your folding period before the crisis and do not let a crisis change it. Rule number 4 is the oil variable. This one matters right now more than most people realize. Not every war rattles the market the same way, and the historical data shows a clear dividing line. Conflicts that disrupt major oil supplies carry a different kind of risk. The 1973 Yom Kippur War triggered the OPEC oil embargo, and the S&P 500 lost over 40% in the following year. Compare that to the Cuban Missile Crisis, which felt like the end of the world at the time, but had zero lasting impact on oil, and the market surged nearly 28% in the next 12 months. Think of oil as the bloodstream of the global economy. A war that nicks a vein is one thing. A war that severs an artery is something else. If you want to understand how any conflict will affect your money, follow the oil. Watch supply routes, watch production numbers. That tells you more than any cable news segment ever will. Rule number 5 is build the buffer before you need it. This is the rule I wish someone had taught me 10 years ago. The families who survive wartime volatility without making a catastrophic mistake are not the ones with the best stock picks. They are the ones who do not need to touch their investments at all. If you have 3 to 6 months of expenses in a high-yield savings account sitting in boring, accessible cash, then a 10% market drop is an inconvenience, not an emergency. If you do not have that buffer, then every red day feels like the walls are closing in and you are one bad night of sleep away from panic selling at the worst possible time. This month, open a separate savings account if you do not have one. Set up an automatic transfer, even if it is $50 a paycheck. You are not saving money. You are buying the right to be patient. Rule number 6 is understand the recovery calendar. Here is a number that should be printed and taped to every investor's bathroom mirror. After major geopolitical events, in non-recessionary environments, the average S&P 500 return over the following 6 months is roughly 8%. Not flat, not negative, 8% positive. Markets do not just recover, they tend to overshoot to the upside because once the uncertainty clears, all the sideline cash comes rushing back in. Imagine a coiled spring. Fear compresses it, clarity releases it. The people who sold during the compression are standing on the sidelines watching the snap. The people who held or even added are riding the spring. This is not a reason to be reckless. It is a reason to have a plan before the compression starts. Rule number 7 is rebalance. Do not react. Here is what the disciplined investor does during a wartime dip that the emotional investor never considers. When stocks fall and bonds or cash rise in relative value, your portfolio drifts away from your original allocation. Rebalancing means selling a small portion of what went up and buying a small portion of what went down to get back to your target. It sounds mechanical, and it is. That is the point. It removes the emotional component entirely. Research consistently shows that households who rebalance on a set schedule, whether quarterly or annually, outperform those who make ad hoc decisions driven by news cycles. The action step is simple. Check your allocation this weekend. If it has drifted more than 5 percentage points from your target, make the adjustment. Do not think about the war. Think about the math. Rule number 8 is separate the signal from the noise. During any conflict, you will hear two types of commentary. The first is signal, actual data about economic indicators, corporate earnings, oil supply, and interest rate policy. The second is noise, speculation, prediction, outrage, and fear-mongering designed to keep you watching. The data suggests that the average American checks their phone over 100 times a day, and during a crisis, that number climbs. Every check is an opportunity for noise to hijack your decision-making. Think of your attention as a fuel tank. Every doom scroll burns fuel. Every speculative hot take burns fuel. And when the tank is empty, you make decisions based on exhaustion instead of evidence. This week, set a rule. Check your portfolio once a day at a fixed time. Read one trusted data source. Then close the app. Rule number 9 is know what actually goes up during war. Not everything bleeds during a conflict. Defense and aerospace companies historically see increased demand. Energy companies often benefit from supply disruptions and higher commodity prices. Utilities and consumer staples, the companies that sell electricity and toothpaste, tend to hold steady because people still need lights and clean teeth regardless of what is happening overseas. Gold and precious metals have been reliable safe haven assets during virtually every geopolitical shock on record. This is not a suggestion to chase these sectors after the fact. It is a suggestion to make sure your portfolio already includes some of them before the next headline hits. Diversification is not exciting. It is a seatbelt. And nobody ever regretted wearing a seatbelt during a crash. Rule number 10 is zoom out until the picture changes. Pull up a chart of the S&P 500 over the last 100 years. Every war, every crisis, every moment that felt like the end appears as a small dip in a line that trends relentlessly upward. The line went up through 2 world wars. It went up through Korea, Vietnam, the Gulf War, September 11th, the invasion of Iraq, the financial crisis, and the pandemic. On the left side of the chart is a number. On the right side of the chart is a much, much bigger number. That is not optimism. That is a photograph. The people who benefited from that upward line were not smarter than you. They were not luckier. They simply did one thing you can also do. They stayed in the frame long enough for the picture to develop. Rule number 11 is talk to your family before you talk to your broker. Here is something no financial model captures. The most damaging investment decisions during wartime are not made at a trading desk. They are made at a kitchen table between 2 people who are scared at 11 o'clock at night after watching 3 hours of news coverage. If you have a partner, sit down this week and agree on the plan together. Say out loud, we will not sell unless a specific, predefined condition is met. Write it down. Sign it if you have to. Behavioral economists call this a pre-commitment device, and it is one of the most powerful tools available to any household. It takes the future version of you, the panicked, sleep-deprived, headline-saturated version, and binds that person to the decision the calm, rational, present version made. Rule number 12 is remember who you are building for. 3 weeks ago, when the headlines first broke and the markets dropped, I did not sleep well. I kept thinking about the college fund, the mortgage, the retirement number that suddenly felt like it was written in sand. But the next morning, I watched my daughter eat cereal and argue about which shoes to wear, and I remembered something. The money is not the point. The money is the vehicle. The point is options. The option to say no to a job that makes you miserable. The option to take a summer off when your kids are still young enough to think you are cool. The option to help your parents when they need it without destroying your own plan in the process. Wars end. Markets recover. The data is overwhelming on that point. But the decisions you make during the fear, those have permanent consequences. The version of me that almost panic sold 3 weeks ago would have locked in a loss and spent the next year watching the market climb back without him. The version of me that sat down, reviewed the data, and stuck to the plan is not a hero. He is just a guy who followed the rules. Pick one rule. Start today. It is just math, but it feels like freedom.